I was recently asked to review the options trading activity in an account that was engaged in a covered call strategy. And what I saw was pretty alarming. It was very clear to me that the advisor in that case was engaged in some activities that were probably not appropriate for this strategy. But today, on Open Interest, we're going to talk about covered calls. Hello, everybody, and welcome. I'm Mike Coe. I'm joined today by a good friend and longtime industry colleague, Matt Amberson. Matt Amberson is the founder of Options Research and Technology Services. And I actually thought it was trading, but I may have that wrong. So we'll talk about that. Matt's background in the options trading industry is similar to my own. I believe he was on the Chicago Board Options Exchange, as it was then called, back when I was on the Philadelphia Stock Exchange, the American Stock Exchange, and the New York Mercantile Exchange, trading a variety of different products. Now, what we're going to cover today is covered calls. And just as a little bit of background to anybody who doesn't know what that is, this is one of the most basic strategies that people who are new to options often begin to engage in. Almost all investors own stocks. And one of the most natural things for people who own stocks to do when they're first looking at implementing options in their strategy is selling calls against the stocks that they own. So what that would mean is that if you own a stock, we'll call it Microsoft, and you want to potentially collect some yield, you could sell upside calls against the stock that you own. The idea being that if the stock stays put, or if it goes up modestly, you'll still see some gains. If it appreciates significantly, you have the possibility that the stock will be called away from you. But in any case, you will be able to collect some premium in this strategy. So first things first, Matt, if I didn't get the name of your company right, and I'm just reading it right off of your lower third there, because I had always thought of it as a trading business as well. Why don't you give us a little bit of your professional background and how you got started in the business, and what you guys are doing now, because I think that's really relevant, and you're going to have some valuable things to share with us.
No, you did get it right. It's option technology, and although we do help a lot of traders out there, yeah, my background, way back in the day, I worked for Lehman Brothers. Would go down there in LA in the mornings at 6:30 and start my day walking bond sheets around. Went to graduate school in Chicago. Went to the floor of the exchange, Chicago Board of Options Exchange, as it was known then, and was successful and started backing traders there. Hired PhDs and statisticians, and we would make our own proprietary analysis. That got popular. I rolled that into Option Research and Technology Services, ORATS, as it's affectionately known, in 2001, and we've been in business ever since, Michael.
So some of the really interesting things that you do is your technology allows investors, traders, strategists to test option strategies, among other things, in a variety of scenarios. And you have a lot of historical data that allows people to do that on a single stock basis and sort of in general. And so what I thought we might do is actually give you the floor, as it were, take you back to your floor days, and allow you to just sort of walk us through the things that work and some of the things that don't work when you're engaged in the covered call strategy.
Yes, absolutely. As you say, it is one of the most popular strategies, but there are definitely some risks and some considerations to look at. And one of the things that you can do is you could just look at the options and in your head figure out what your return might be. But there are some more sophisticated analysis that we like to do. We've started a backtesting service, kind of pulled by our clients. And what you can do with that service is you can then determine the biggest questions in a covered call once you've decided to do the strategy. Is, what is the expiration? How far out do you want to go? And also what strike? How far away from the stock price do you want to sell that call? So one of the things that we could do is we could look at many different symbols. We'll do a sample set of the S&P 500, and we will then look at testing many different days to expiration, when you're going to trade out, from 10 to 200 days, and also, different strike levels. So we've done this huge test for this call, almost 6,500 different back tests, where you simulate selling a call and see how the call performed, and then you kind of present that like a hedge fund might present something. What is the average annual return? Win rates and those types of things. So after all this testing, we get some results. The best maturity of the various ones that we tested was 30 days, and that's a pretty standard maturity that people use. So people will be happy to hear that. Interestingly, we did this test back to 2007. The best delta, or delta is a relative strike to stock price measurement. So you could either use a percentage of stock price or delta, and I'll tell you why we use delta. 10% out of the money means a lot different from Tesla to JP Morgan, for example. JP Morgan has much less of a chance to get to that level than a Tesla. So the delta will normalize that. So when we do back tests, we like to use delta so we could do some comparison, and we could throw all these disparate stocks in and get some intuition on what type of strikes to sell, what are the best deltas. So that's the reason we use delta there. And you could think of delta as, it's not perfect, but you could think of the chance of it finishing in the money. So a 10 delta might be a 10% chance of finishing in the money for that strike that you sold. So you sell a strike slightly above the stock price, and if it finishes below that, you collect. If it finishes above that, you either have to sell or buy the option or get exercise on the stock. There are some other considerations, though. Not just now that you're in the stock, should you when are you going to get out? So we'll look at what the best time to exit is, and we, in the back test, we look, should you do it after 75% profit or at expiration? And in the past, we've done a lot of different ones, but for this test, we've just chosen those two. And also, we look at, should you hold this short call through earnings or not? So what we've done then is determine that. And so the answer to the first question is, it's better just to hold it all the way to expiration. And then, at least my intuition for that is, you're selling these kind of out of the money calls. You don't want to close them out too much. You want to squeeze as much out of that as possible. As market makers, we would never do this. We'd always try to close out our short options. But in this particular case, you want to get that annual return all the way to the end. And you don't want to have to pay some wide bid ask as well to buy that in. And then the answer to the second question, now earnings. Earnings is a very special time around stocks, as you know. Stocks tend to move either up very far or down very far. The thing about a cover call or a short call is it doesn't provide that much protection. So if you think about the risk reward, it doesn't provide much protection if the stock were to go down. Now, if the stock goes up, it might go through your call and you might lose money that way. So I think that's the intuition around earnings, is that it's better to exit and not be short that call around earnings. And those are kind of the findings that we have now. So now that we're done with that back test, I think it's interesting to look at a couple of examples here. And the first one I'd like to look at is Microsoft. Microsoft has done quite well since 2007. It's up 19.6% on an average annual basis. The rule of 72 is it doubles every 3.5 years, something like that. So if you started with the investment of 100,000, it got up to 400,000. And what you're looking at is a a purple line that shows the covered call strategy, and an orange line, they're very close to each other, that shows the actual stock price. So in this case, there wasn't a whole lot of difference in Microsoft returns from a long stock to the covered call. Slightly less for the covered call, but a slightly higher Sharpe ratio. Now, a Sharpe ratio looks at your average annual returns and divide it by a volatility. So the reason the annual return is lower and the reason the Sharpe is higher is because it does dampen some volatility there. That's one of the benefits that you get with the covered call. So in this case, not much going on there for the covered call. It's basically a wash there. So the next example I'd like to look at is MasterCard. Now, MasterCard is a stock that did a little bit better with this covered call. You could see the purple line is on top of the orange line for most of the time. You get about an extra % of return, not on average over this time period since 2007, and then a slightly higher Sharpe ratio. Again, the covered call does dampen that volatility and provides, in this case, a better average annual return. So, and you might be looking at this and you go, well, that's not much different. These 10% chance calls, these 10 delta calls aren't really doing a lot here. What if you were to sell something a little bit bigger, and could you get more money? The answer is yes. And by the way, that those didn't test very well in our back test. But I'd like to show you one of the problems with a cover call, and especially a problem with selling something that has a higher probability of finishing in the money. So the next one I want to show is Ford. Now, Ford, just looking at this graph, it looks like it might be a great candidate for a covered call and move sideways for quite a long time. However, I'd like to point out that the average annual return is less than half of just owning Ford stock over that period for this 30 delta. Now, the 10 delta did perform better. It was about a 12% return, but still, that's much less than the 16. And I'd like to point out something. I'd like to draw a little circle around the reason that this has done worse, is that it just had a violent move up from the global financial crisis lows in 2009. It was up 200% in a relatively short period of time, about 12 months. This is very bad for a covered call strategy, because what's happening is you're continuing to sell these calls and you're continuing to get your stock either called away, or the profit from those calls is very bad. So what you could see that gap widening between the stock in orange and the covered call in purple, and selling these calls, you just never make up that massive appreciation that the stock saw and how much you lost on those calls. It's really difficult to make that up. So this is one of the problems with covered calls. So I'd like to give some final thoughts here. Just on backtesting itself. So backtesting, we didn't know that the 10 delta was going to be the best. If I were doing a cover call, I would do it slightly more out of the money there. But backtesting, could be you could overfit, or most of the strategies that we saw were a drag on returns. So the one that we're picking, people say I've never seen a bad backtest. Well, we show all the results, and many of them didn't work that well. And the covered call just didn't add that much to as a comparison to the long stock. Another thing I'd like to talk about in general, another thought that I had is just the risk and reward of the covered call itself. Now, I think the intuition is that the equities, they don't move in a standard up motion. You often get a lot of your returns in a very short period. As we saw in Ford, if you have a covered call on that, you're going to lose that opportunity. So, my feelings about the cover call is that, since these returns are so uneven, it's not really a set it and forget it type of a strategy. It's a strategy that we've seen that you want to avoid earnings, you want to avoid these big moves in the stock. So I would consider it more of a tactical strategy, where might say to yourself, hey, I want to sell this stock at this point. Maybe I don't want to take the capital gain, so that might be a good time to use the cover call. But as we've seen, and the backtesting has shown, that as a set it and forget it systematic strategy, I might think twice about using this cover calls, Michael. So those are my thoughts on the cover call.
Yeah, I think that's great and really helpful. Thank you for that. Folks who watch Options Action, which is the show that we do on CNBC and have been doing since 2009, will probably observe that covered calls are a strategy that we've barely ever mentioned. And some of the things that you just highlighted here represent some of the reasons why. The situation in Ford, you talked about the results that you saw coming out of the credit crisis. It's important, I think, for folks to remember that you have, number one of the dynamics that you talked about, which is that there are specific catalysts. There are events which tend to represent a disproportionate amount of a single stock's returns. So that could be conferences and shareholder meetings, it could be earnings, it could be economic announcements. Of course, in this specific instance, the credit crisis low in Ford represented an 87% decline from the mid-2007 highs. The market capitalization of Ford actually dropped below $6 billion at that time. So one of the important questions that people should be asking themselves if they're writing covered calls against a stock is, what are my expectations for this stock? If you owned the stock when it was multiples higher than it is now, and you, for whatever reason, you continued to hold it through those declines, which I'm sure many people did, when you sell covered calls, you are giving the market the opportunity to buy that stock from you at a significant discount, potentially to your cost basis, which means essentially that you could be giving somebody else the right to buy the stock from you at a price that would lock in a loss. And I think that's one of the important points that people ought to be thinking about. If you own the stock and you think that the company's reasonable valuation is $40 billion and the market capitalization for it now is $6 billion, there's probably no covered call that would make sense to sell. Now, that's not to say that it doesn't make some sense. There are a lot of big institutional money managers. I'm sure, Matt, you're aware of them. I mean, Leon Cooperman, former Goldman Sachs asset management head, the guy who runs Omega, he sells covered calls and he sells cash covered puts. Many times he sells both against stocks that he owns. So he sees that a stock is approaching a level where he might be interested in exiting. It hasn't quite gotten to his target exit price, so he'll start selling calls against his existing position. If the stock falls back almost to a level where he is interested in reloading or purchasing more of it, he might sell some cash covered puts. It's going to be rare, and this is an important point. Covered calls and cash covered puts are very similar, right? So these two positions have remarkable similarities. But one thing to think about is that if a cash covered put is where you want to get long a stock, and selling a covered call is where you might want to exit it, then I suspect you're not going to often find circumstances where these two are very close together. So let me ask you this. What are your favorite instances to use them if you use them at all? Because I'm sure in many cases as a general strategy it's not great. But where do you like to see people implement? I'm sure there are times when it is appropriate.
Yeah, absolutely. Great points there. And just to your point a little bit there too, you have a stock that could be so far up and so far down. If you're selling a covered call, you don't want to give away your upside. This is a very risky asset. you don't want to treat it like a bond. You want to be able to participate. And so to answer your question, yeah, when the one of the tests that we've done is searching through many different stocks and looking for extremely high premiums, 2% for a premium. Those are the calls that you like to sell. Those are the back tests that actually look good out there. So price is a definite factor, and especially if you can search the whole environment and find some of these stocks that have tremendously high calls. Those are some of the best ones to sell. Some of them are way out of the money, and you could get quite a bit of premium, Michael.
Yeah, that's a phenomenal point. One of the rules of thumb that I've sometimes thought of is that if my expected return for equities is 10% per year or thereabouts, and I'm looking to supplement that by selling some of my upside, I want it to be a good offset for that anticipated annual rate of return. So one of the rules of thumb that I've sometimes thought about, that I've offered to people who might not have every financial tool available to them to do the kind of analysis they might like, is to look for yields that are in the neighborhood of what you expect to make for equities. So if you expect to make 12%, then you're looking for about 1% monthly in terms of your premium collection. And the other thing is that I want to make sure that there's some buffer so that you still have 2.5%, 3.5% or more even before you get to your short strike. And what that ends up doing, I think, is it eliminates a lot of possibilities. If you have a relatively low volatility stock, you're going to see that that's probably not a great candidate for a covered call strategy. Has that been your finding as well?
Yeah, and just thinking about your hedge fund example, those guys are really have it down on which calls to sell against which underlying assets. One of the things that one of our large clients noticed is these conferences that they put on, investor conferences, investor meetings. Those are another place where you don't want to be short these calls against those stocks, because those are days when you could have outsized returns on even some of these stocks that aren't that volatile. They'll pop one day, and there goes not only your return on the stock, but you lose on the calls as well. So you really need to think about the calls and the timing, and if you can identify those times, conferences, earnings, overall economic announcements, to avoid being short. But there are times when you can be short and collect the premium, but you really got to watch out for those times when you get that stock go against that call.
Yeah, I think that's a great point. And I think we also intend to do a follow-up video with more specific examples of do's and don'ts. But in the meantime, Matt, people who are interested in options research and technology services, what is your website, and do you offer services that are appropriate for self-directed investors?
Absolutely. We have clients from the largest pensions down to people in their basements trading options. So definitely. ORATS.com is our website, and we have tools that are UIs that operate on the internet, and then we also have data. If you're a quant, there are APIs to get at our data. So come by ORATS.com. There's quite a bit of offerings. This is a tough business out there, competing with some of the largest hedge funds, and that's what we've tried to do. We try to bring, as a market maker, I was exposed to all the things that you need to be successful, and we've tried to bring that and give that to people at ORATS.
Really appreciate your insights, and I've used your technology as well and find it exceptionally helpful. For all of you who like this kind of content, please be sure to hit that like, subscribe, notification bell, and stick around when we do our next video. Hopefully Matt will be able to join us for that, where we're going to go over some examples of some very poor, I think, covered call choices that I've seen some advisors make, and talk in a little greater depth about what's wrong with that. But for now, thanks very much for watching.